Okay, last lecture we saw that how is valuation of rights and earnings based model is like. Okay, we learned that, we did some questions. Okay, so practice it well. Now we will start with our valuation of bonds. Okay, so what is a bond? A bond is a fixed income security. Okay, companies issue bonds, okay, in the market, and mainly it is government who issues bonds. Okay, there are various kinds of bonds issued by government, and mostly it is for long term. Usually it is for long term, and they issue it. Okay, so what is valuation of bonds? We are trying to find whether this bond will be valuable for me. Okay, this bond, the price at which it is being traded in the market, is it right? Should I invest in it or not? Okay, so this is what this part teaches us. Okay, so the first topic is bond pricing. So bond pricing, what do you mean by bond pricing? The price of bond. Okay, the rupees term of bond. So here we need to find the rupee terms. Okay, so this part is mostly the intrinsic value. You will need to find the intrinsic value. The answer which you derive in this part will be of rupee value. Okay, so what are the types of bond? How many types of bond can it be? There can be broadly three types. Okay, broadly three types of bond. Which one is it? The first one is redeemable bonds. What are redeemable bonds? They are redeemed after a certain period of time. Okay, they have a maturity period. Okay, when the maturity period ends, the bond is redeemed. Okay, it may be redeemed at par or at a premium. It will be given in question. Okay, next, irredeemable bonds. So in redeemable bonds also, what will be the income factor? In shares you get dividend, in bonds you get interest. Okay, fixed interest percentage you get every year. Next, irredeemable bonds. As the name suggests, it is irredeemable. So irredeemable means it is not redeemed at the end of the period. Okay, let's suppose you have taken a bond for you have purchased a bond for 1,000 rupees. Okay, the principal amount you will never get. In redeemable bonds you will get the principal amount plus interest amount. Okay, so what is zero coupon bonds? As the name suggests, zero coupon means interest rate. Okay, coupon means interest. In this chapter, in this part bonds, always remember, it will be given as 14% bond. Okay, 14% bond, 14% treasury bill, 11% treasury bill, 11% T bill, something. Okay, so the first part, or if I take an example of debentures, how it is given? 14% debenture. Okay, so the 14%, what is the name? In the name it will be given 14% bonds. Okay, the 14%, it is known as coupon rate. Okay, interest rate, it is different here, and coupon rate is different. Coupon rate means the rate at which you will get every year interest. Okay, interest rate is what is prevailing in the market. Okay, this is the basic difference. So zero coupon means zero interest bond. So if a bond is being issued and there is zero coupon, okay, why does one invest in a bond? He wants interest. Okay, fixed interest he wants. So how does this zero coupon? It doesn't make any sense, right? So what do they do is, let's suppose the face value is 1,000. Okay, let's suppose the face value is 1,000. Can you see? Yes, right? 1,000 is your face value of the bond. What will they do? They will issue it as discount. Discount how much? They will do it as 850. You will purchase it at 850, and at the end of the period you will get it as 1,000. Okay, you will buy it at 850, and at the end of the maturity period you will get it for 1000 rupees. Okay, it will be redeemed at par. So this is the basic thing about a zero coupon bond. Okay, what is the intrinsic value of the bond? Intrinsic value, what was the intrinsic value of security? What was the intrinsic value of shares? It is the same concept here. Okay, the PV of all future cash flows from the bond discounted using the required rate of bond, that is yield on similar bond. It is the similar to your dividend. Okay, like how you used to do in shares, it is similar only. Okay, you will take PV of all future cash flows. Cash flows means what? In shares it was dividend, here it will be your coupon rate. Okay, it will be your cash flow. And bond discounted using the required rate of return. What was the required rate of return in shares? In shares it was KE, and here it will be your interest rate. Okay, or require or KD or anything you want to say. Okay, you might be able to find it in the paper, in the question paper. That is yield on similar bond. Required return on bond is yield on similar bond. Okay, that is what is being, what if a similar bond is getting 10%, you will also want 10%. That is your required rate. Okay, basic cheese. It is calculated for each type of bond as follows. Okay, redeemable bond, how it is calculated? How is the price calculated? How is the bond price calculated? Simple. PV of interest component. Interest means coupon. PV of coupons. Okay, how many 10% every year you will get. Okay, you will do PV of it. Okay, so that you can get the price at zero time. Okay, present value you can get. Okay, future ka you will do PV of interest. Okay, plus redemption, plus PV of redemption amount. Same cheese. Okay, same thing that you have learned in dividend model. Okay, the same thing is being applied here. In formula terms you can look at it. Okay, I find this very easy. Okay, this you can do it. That is interest into 1 upon K upon D. What is 1 upon KD? Let's say, let's assume KD is 8%. Okay, 0.08 plus 1. Okay, so 1 divided by KD into 1 divided by KD, it is 925. Okay, so like that you have to multiply with interest. In formula terms it is given like this. Okay, and the redemption amount, it is also same like we used. Redemption amount, how will you do it? The end term, the end of the term you will get, right? The end of the term into let's say it was 8th year. Okay, 8th year, the PV factor of 8th year you will multiply with your redemption amount, and you will also get interest for that year, right? So you will take both of it. Okay, here KD is required rate of return on bond, that is yield on similar bond. N is the number redemption year. Okay, example, it is given here that face value of bond was 1000. Interest or coupon rate? Coupon rate, we'll take it as coupon rate. Interest is confusing. Okay, we'll take coupon rate. Coupon rate is 10%, redeemable at par at the end of 3rd year. Okay, 3 years only maturity period. Okay, required rate is 12%. This will act as our discounting factor. Calculate intrinsic value of bond. How will you calculate it? First we'll write year 1 2 3. Okay, we'll do cash flow 100. Then we will do PV factor. Okay, 12%, 8 1 2 3. Okay, and then we will do PV of it. Okay, at the end of the time what we will get? We will get redemption amount also. Okay, so for year 3 we will get redemption amount as 1000. Okay, face value of 1 we will get again. Okay, 1000. What will be the value of it? We will PV it with the 3rd year discounting factor, and we will get an amount. We will total it and we will get what? Intrinsic value of it. Okay, basic cheese, basic funda. It's very simple. Next, irredeemable bond. So for irredeemable bond, what is the main funda of it? What is the main funda of irredeemable bond? Irredeemable bond is you will not get your principal amount back. Okay, you will not get your principal amount back. You will not get your 1000 rupees. This is the simple funda. And here there is no concept such as growth like in equity. Okay, in equity you get growth. Every year you get growth. In bond there is no growth. You will get fixed rate of interest every year. There is less risk. Okay, no risk, so there is no growth also. So we'll take the same example, irredeemable bond, face value is 1000, interest rate is 10%, okay, return is 12%. So how will we do it? We'll just do it like our perpetual cash flow. We saw it, right? What is it? First perpetual cash flow, that is, how much is it? 1000 into 10%, right? 100 divided by KD. KD means what? Your discounting factor, divided by 0.1. 1000. Sorry, it was an interest rate, right? I misinterpreted that the discount rate is 10%, it is 12%. Okay, 1000 divided by 0.12. You will get what? Your intrinsic value. Very easy, very easy. So in this AFM, okay, AFM, if you want to master it, the main thing you have to do is you have to study time value of money. Okay, if you study time value of money, if you understand it well, if you are able to do time value of money very well, then you will be able to crack this. Okay, it is very easy, it is all logical. Next, zero coupon bond. What is zero coupon bond? Bonds which are issued at discount and redeemed at face value, as I told you earlier. Okay, what is the intrinsic value? Intrinsic value is PV of redemption amount. Okay, so do we get in between in years? Let's suppose the maturity period is 5 years. Okay, the N is 5 years, the time is 5 years. Okay, so in between that you won't get any income, you won't get any cash flow, so we won't do PV of cash flow. Okay, PV of interest. So here it will just come PV of redemption amount. If okay, PV of redemption amount, we'll multiply it with the PV factor at the end of the term. Okay, in actual value it is redemption amount into PVF of the redemption year. Okay, in formula terms you can write it like this. Okay, V0, that is intrinsic value, is equal to face value divided by 1 plus KD divided raised to N, or face value into 1 upon KD N. Okay, so here we see that the face value of zero coupon bonds in one is 1000. Okay, face value is how much? 1000, which is issued at a price of rupees 900. Okay, 1000 ka face value. Okay, it was issued at a discount at rupees 900. Okay, maturity period is 3 years, required return is 12%. Okay, our discounting factor is 12%, maturity period is 3%, 3 years. Okay, so how will we calculate? 1.12 divided by 123. Okay, this is my redemption value, redemption PVF into redemption amount. How much is it? 1000. Okay, how much did I get? 711 or 712. Okay, this is my intrinsic value. Okay, there are some notes, some important notes which you need to understand. Okay, it will be important. If face value or nominal value of bond is not given in question, okay, if face value is not given in question, then we will assume it as 100. Okay, if redemption amount is not given in question, then assume it as redeemable at par, that is at face value. If redemption amount is not given, we will assume it as it will be redeemed at par. Interest on bond is always calculated at face value. Okay, interest on bond will be calculated at face value. If your face value is 1000 and your interest or coupon rate is 10%, you will calculate it on face value only and not your issue price. Okay, interest is also known as coupon rate. Very basic. Redemption period means maturity time or period of bond. Okay, very easy. It is different yield. If different yield rates, spot yield curve is given for each year, then calculate PV of cash flow of each year using the yield rate of that year. What do you mean by yield? Y-I-E-L-D, yield. Yield means return. Okay, yield means return. That is, how much are you getting from investing in it? Okay, let's suppose in this example, how much are we getting? We are, let's suppose we are, it's not zero coupon bond, okay? It was redeemable bond, okay? It was issued at discount price, okay? Its coupon rate was 10%, okay? 10% means how much? 100 divided by 900. How much will it come? 100 divided by 900, it will come to 11.11%. okay, this will be my yield. Yield means return on income, okay, return on investment. How much return am I getting from investing a certain value? Okay, that is known as yield. So here they are telling that yield rates will be different. If different yield rates are given in each year, okay, what will be my yield rate? It is also like discounting factor, okay. If you are getting similar interest on similar yield on different bond, then you will also expect that much, okay. So it also acts as your discounting factor, okay. So here what they are saying that if different yield rates are given, okay, for every year different yield rates are given, if you want to calculate it accurately, you want to use this, okay. For every year you will use different yield rates, okay. So we'll understand with an example, you will understand it better, okay. The face value of bond is 1000, interest rate is 10%, okay. So interest is 100 rupees, redeemable at par at the end of 3 years. Yield rates, what is yield rates? It is discounting factor. Year 1 it was 12%, year 2 it was 11.5%, year 3 it was 11%, okay. How will we calculate it? So for first year we will do it as the interest divided by the PVF of first year, okay. Then interest divided by PVF of second year, but the discounting rate will be different, 1.15, okay. So how will we do it? 1.115 divided by 1, 2. We'll multiply it with 100. This will be my second year's PV, okay. Like that we have to do all of it. 11 divided by 3, and the bond will be matured in the third year, okay. The third year's discounting factor is 11%, so we'll do it with 11%, okay. If we total it, we'll get V0, okay. You have to, this is very easy, just understand it, okay. Calculation of expected market price on the basis of intrinsic value of bond, okay. How will you calculate the expected market price on the basis of intrinsic value of bond? We'll just do it like intrinsic value of bond into beta of bond. There is also a concept called as beta in bond too, okay. We'll discuss what is beta in detail in portfolio chapter, okay. Before that you have to just go on with it, that beta is the risk factor, okay. So when the IV is intrinsic value of bond is 974.03, beta of bond is 1.02. What is the expected market price of bond? It will be 974 into 1.2, that is 1168. Very logical? Yes. The next concept is types of yield curve, okay. A general parlance if we take, okay, if you are depositing 1000 in your bank, okay, if 1000 is very small amount, we'll take 20,000. If you are depositing 20,000 in your bank, okay, I'll just write it so you get. Okay, you are a person here, his name is Ram, he has how much? 20,000 with him. Now what he wants to do, he wants to invest this amount in bank. This is my bank. Okay, he wants to invest in bank. Bank invest. I mean, he wants to do FD. He wants to do FD in bank, fixed deposit in bank. So he is asking the bank, if I keep it for 1 year, how much interest will you pay? The bank is saying for 1 year it will be 7%. Okay. So I asked, if I keep it for 2 years, how much will you give? The bank said 8%. If I keep it for 3 years, how much will you give? The bank is saying for 9%. If I keep it for 5 years, how much will you give? The bank is saying, yeah, we will give it for 11%. Okay. So what is happening here, that as the time increases, the interest rate also increases. Okay. The more risk is involved. As the time increases, the more risk is involved, the more return is given. Okay. This is the basic funda. Okay. So this is normal. In long term, you will get more. In short term, you will get less. Okay. So this is the basic concept. So here what happened in normal yield curve, it happens in a market where long term bonds has higher yield in comparison to short term bonds. Okay. So if we take it in the example, for 5 years it was more. Okay. For 1 year it was less. Okay. So for short term it is less, and for long term it is more. This is normal. Okay. So it will be like this. If we put this in a graph, it will look like this. Okay. Here it will be years, and here it will be yield rates. Okay. For 1 year, 2 year, 3 year, the curve will be like this. Okay, upward. But what happens in inverted yield curve? Okay, that short term will have high rates and long term will have low rates. Why does this happen? It will happen because the market is expecting a recession period. Okay, that time it will happen. It happens in a market where short-term bonds has higher yield rate in comparison to long-term bonds. Okay, that is a market in recession situation. If an investor or if the market is expecting a recession in further years, it will not be encouraged to invest in long term. Okay, then they might know that there is more risk and the rate will come down. Okay. Next, this one is also important. Okay, this one is mainly dealt in. This one is important. Okay, just listen to me. If there is a semi-annual interest or coupon bond, okay, what it means that sometimes government issued T-bills, treasury bills for 6 months. Okay, for 6 months. So what do they say, that it is for 6 months or it is for half yearly? Okay, so it might say that it is for half yearly. Okay, there is also some bonds where the government pays interest twice a year, that is half yearly. They will pay semi-annually. Okay, at that time what we need to do? Okay, for ease of calculation and accuracy of calculation, what we need to do? First we will do, this is logic. Okay, convert the interest rate into semi-annual rate. Okay, what will you do is, if the interest rate is 10% and the maturity period is 5 years, okay, maturity period is 5 years, what we will do, we will first convert the interest rate into semi-annual rate. Okay, that is by dividing it into, interest rate will always be annual. Okay, so if they are saying that interest is being paid semi-annually, we will divide the interest by 2. Okay, and we will keep it. Why is this done? Why is it not given just once? Okay, it is because you will get cash flow. Okay, you will get cash flow every 6 months. Okay, so every 6 months you need to document it. That's why we are doing this. Okay, so we will divide it into semi-annual rate by dividing it into, so interest rate, if it is 10%, we will take it as 5%. Convert the discounting rate into semi-annual rate. Discounting rate is what? The required rate of return. We will divide it into 2. Okay, if we are expecting 12% return, we will divide it by 2, it will be 6%. Convert years into maturity. convert years to maturity into half yearly periods. Okay, if my maturity period was 5 years, okay, I will make it as 10. Okay, we'll multiply it by 2. This is the basic thing. Okay, so we'll look at an example so we can understand it better. Okay, what is it? The face value of bond is equal to 1000. Face value is given. Interest rate is given 10%, which is paid semi-annually. Okay, interest is always given in per annum basis. It is semi-annually. It means 5% you will be getting every 6 months. Okay, redeemable at par at the end of 3rd year. Okay, required rate of return is 12%. Okay, so now what we'll do, we'll make the required rate into half, discounting rate into half, interest rate into half, and the period, 3-year period, will multiply it by 2. So it will become 6. So here the half yearly periods 1, 2, 3, 4, 5, 6. Okay, and last we'll get maturity amount, and PV will do it by required rate, will make it as half, and we'll get PV factor also, and we'll get PV. Okay, and by calculating it we'll get what? Intrinsic value. Now if in question it is also given as calculate the expected market price of the bond, if they are given, and they are also given beta of the bond. Okay, let's suppose it is 1.2. Okay, now what we'll do, this is the intrinsic value, right? Intrinsic value into 1.2, we'll get our answer. Okay, this is what? This is this concept. What? Expected price, market price of bond based on intrinsic value of bond. Okay, if they are asking expected market price of bond and they are giving beta of bond, we need to calculate it with intrinsic value. Okay, so this was all about the bond pricing. Okay, we'll do another concept, bond yield. Okay, and then we'll move on to questions in next lecture. Okay, so what is bond yield? Bond yield means the bond percentage. Okay, the bond percentage, how much percentage of yield, how much percentage of return are we getting from the bond. Okay, so here basically we need to what find? We need to find percentage. In pricing what we need to find? Rupees, and here we need to find percentage. Okay, what is given? Let's see. It is the return on investor. It is the return an investor gets on his investment on market price in a bond. Okay, so as I explained to you earlier, that how will you calculate return? You will calculate return on the investment you have made in it. Okay, the investment you have made in it and how much return are you getting. This is basic. Okay, so bond yield can be of two types. Two types of bond yield we are calculating. Okay, the first one is current yield. Okay, the first one is current yield. What does it do? It considers only interest payments received on the bond, that is ignoring redemption amount. Current yield, as the name suggests, what is current? Like current liabilities, what will happen? It is for short term only. Not short term exactly, but only the interest component, how much you are getting. Okay, the interest component, how much you are getting, you will calculate this. Okay, forget about this current liability less than 1 year. Just for remembering it, I give you that example. Current yield means what? Current yield means only interest component, interest payments received on a bond, how much is its value. Okay, how much yield are we getting from interest, that is what is calculated in current yield. In question we do you will understand it better. Okay, what is yield to maturity? The yield to maturity is similar to your IRR. Okay, in IRR you do interpolation, right? So like that it is. So what we do, it considers total payments received on the bond till maturity, including redemption amount. Okay, including redemption amount we will do PV. Okay, PV of it, and we will try to find the yield rate. The yield rate at which the market price is based. Did you understand? If you didn't understand, we'll do questions. Okay, you'll understand it better in the next lecture. Okay, here we'll have examples also, so you'll be understanding it better. Okay, what is redeemable bond? In redeemable bond, how will we calculate yield? Okay, similar current yield. How will we do it? Interest divided by current market price of the bond. Okay, into 100, you do it for percentage purposes. Okay, next YTM, the rate at which PV of all future cash flows from bond is equal to the current market price of the bond. That's what I told you earlier, that it will be equal, the yield percentage will be equal to the current market price of the bond. Okay, it is calculated using trial and error method, which means that you will take two rates, okay, and you will calculate PV and you will do interpolation, and after interpolation you will get a rate. Okay, interpolation we have also learnt in dividend based model also, very easy. We'll see how to do it. Okay, here is an example given. Okay, the face value of the bond is 1000. Okay, basic interest rate is 10% and redeemable at par at the end of 3 years. Okay, the current market price of bond is 950. Okay, keep this in mind. Okay, the current yield and YTM of the bond. Calculate current yield and YTM of the bond. What is current yield? Current yield's formula. If you want to remember formula, or you want to remember it logically, remember it logically. How it is? That interest divided by how much you invested. Okay, that is your current yield. Okay, so how will we do it in this sum? We'll do it like, what was the interest? 10%. Okay, so face value was 100, face value was 1000, so interest rate is 10%, so interest is 100. Okay, divided by how much would you have bought the shares for? Is it for 1000? No, the current market price was 950. You would have bought it for 950 only. Divided by 950, how much is it? 10.52 into 100. So your current yield is 10.53. Okay, 10.53%. Is it fixed? Yes. Nice. Next we have to do it in YTM of the bond. YTM. Is there anywhere in the question mentioned a discounting rate? No, right? There is no discounting rate. So what we need to find? Discounting rate. In question, always ICI gives you two rates. Okay, use that two rates to find it. Okay, as simple as that. We don't need to just calculate and forecast what will it be. It will be 10%, 20%, trial and error. No, ICI gives you two rates. Use that two rates. Okay, they have given you 3 up to 3 decimals. Use that in the formula as it is. Okay, so what we need to do for calculating YTM, like IRR, like you have studied in CA Inter also, and now also time value of money, I'll explain to you multiple times. Okay, how to calculate IRR or how to do interpolation. Okay, so here 1 2 3. Okay, cash flow we'll get. Okay, in YTM we'll also include redemption amount. This is very important, and it is yield to maturity. Yield, that is, yield means what? Yield means your interest rate, and to maturity means your redemption amount. Okay, if you make it together, what is it? Interest to maturity. Okay, simple. So we'll take it total 12%. It is given here. You will calculate PV factor 13% is given. We'll calculate PV. Okay, here we'll get PV amount, you will get PV amount. Now interpolation. I have explained it you in last time also. So how will we do interpolation? It will be, see here, how much are we getting? How much are we getting? Lower rate is 9.952, right? I guess you will understand it better like this. So 952.20. Here it is 12% and here it is 13%. Right? 952 here it is given, and 929 it is given here at 13%. How much do we want? We want at 950. How much is it? Okay, 950. How much is it? So the rate lies in between this, right? So we'll do this divided by this. In the total period of this, how much is this part? We'll calculate. How we'll do? 952.2 minus 950 divided by 952.2 minus 929.10 into higher rate minus lower rate, that is 13% minus 12%, okay, and here plus lower rate, okay. This is your formula basic, okay. If you want to remember the formula, remember the formula. If you want to understand it logically, you can do it like this, okay. So we'll get an answer of 12.10. Okay, clear? It's very basic. If you understand time value of money, you will be able to do it anything. You will be able to do anything. Okay. Irredeemable bonds. What are irredeemable bonds? Irredeemable bonds are those which do not have maturity value. Okay, which there is no maturity. Okay, in this bond only interest payments are received as it is not redeemable. Hence, current yield only can be calculated. No YTM. YTM what we need? YTM we need yield to maturity amount also. There is no maturity in this irredeemable bond. So where will we get maturity? So here current yield or YTM, it is the same. Okay, interest upon current market price of the bond. Okay, next. In zero coupon bonds, now we are in dilemma. Okay, there is no interest. How will we calculate current yield? So current yield cannot be calculated. If there is no interest, current yield cannot be calculated. Only YTM can be calculated. Okay. So how it is done? See, the formula here is YTM is equal to face value divided by current market price of bond divided the whole by, in the bracket, the whole into 1 upon n, the fraction. Oh my god, minus n, minus 1. Oh my god, what is this formula? How will I remember this formula? How will this 1.1 upon n, how will it be calculated? It is dirty power. I don't know how to do it. I'm very much scared. Don't be scared. I'll tell you how it is derived. Okay, it is very simple. Okay, this looking at this formula, you will try to mug it up like crazy. How will I be able to do it? It is so big formula. What if I do something wrong? No, you can simply derive it. How? See, I taught you this one. Zero coupon bond. Yes. So zero coupon bond, how did we get the intrinsic value? B0 or rate. How did we get it? We got it by redemption value into PV factor of the redemption year. This is very simple, you understood. Okay. We calculated in formula terms also. Face value into 1 upon KD. Right. KD raised to n. Raised to n means what? Raised to the number of years. This was very easy for you. Right. Now take this formula. Take this formula and put it here. Okay. The same formula. V0 is what? Your intrinsic value. What is your intrinsic value? It is your current market price. Right? Yes. It is your current market price. Right? V0 is your current market price, your intrinsic value. Is equal to face value divided by 1 plus YTM. Okay. YTM means what? Your KD. Okay. Here I have written KD. You might understand it, right? Here I have written KD. Here I have written just twisted it to YTM. YTM is the same? Yes. Now what? Raised to n. Okay. Now we'll do shuffling. We'll keep this here and we'll bring it down here. Okay. We got it here. And CMP, current market price, we got it here. Face value divided by current market price. Okay. Now what we need to do here, when you see 1 plus YTM raised to n, I don't want this. Okay, I don't want this term. I want this to be transferred to there. Okay, I just want my yield to maturity. I just want a rate. Okay, how do I get the rate? I'll write this YTM. 1 goes there. It is in plus. 1 is in plus. If it goes to that side, it will become minus. Okay, this raised to n, it is in power. Okay, if it goes to next side, it will become in 1 upon n. It will become divide. Okay, it is in multiplier, right? It is in multiple, right? It is in power. Power means what? Multiple. Okay, here it will come in divide. So what happened? FV divided by CMP, okay, raised to 1 upon n, that is your power become, your multiplication become divide and your plus becomes minus. Okay, this is the formula, so simple. Okay, don't try to mug it up, try to remember it logically. Okay, the next one, answer will be in decimals, multiply it by 100 to get YTM in percentage. Okay, now example is given here. Face value of zero coupon bond is 1000. Okay, current market price of bond is 900. Maturity period is 3 years. Calculate YTM. Okay, what is given? Face value is given, current market price is given, maturity period is also given. Very easy. We'll put it in the formula. How will we put it? What is given? What is given? YTM is equal to face value of 1000 is given, right? 1000 is given and current market price of 900 is given, and we'll take it as the maturity period is 3, that is n what? N is 3 minus 1. I put it in the formula. Very easy. How will we solve it? Oh my goodness, how will I solve this fraction? This fraction I see, I get very much anxious. Okay, I don't know how to solve this. It's very simple. Okay, calculate dirty power. How to calculate? I'll just show you. Okay, 1000 divided by, first what we need to do is take this amount as in points. Okay, we just want one number. What? How will we do it? In calculator, take it as, we'll have to eliminate the fraction. Okay, 1000 divided by 900, it is 1.11 1.11 raised to 1 divided by 3 minus 1. Okay, now how will we solve this? For this we have, what we need to do is, in calculator there is a trick. Okay, so here in basics also Ajay Agarwal sir has given us. Okay, we'll just follow that. We got it. Okay, 1.11. We'll press under root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, now we have to reduce minus 1 from it. Okay, I minused it. Now what we need to do? We need to do plus equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. What happened, Ray? Wait a second, my calculator is not working. 1000 divided by 900. Okay. Okay, 1000 divided by 900. Okay, 1.11. And we have to do under root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. Then we subtract 1. Okay. And then we multiply it by the power. What was the power in the question? 1 divided by 3. Okay. So how will we do it? We'll take it in decimals. 1 divided by 3 is 0.33. Okay. Into 0.33. Okay. 33333 for accuracy. Okay. Now we'll multiply equal to 12 times. 1, 2, 3, 4. My calculator is not working. I'll keep it in the sun for some time, okay, and then I'll start the video. Okay, it's almost charged. How much was it? my calculator is not working. You will get the answer like this. Okay, so what you need to do, just follow the steps. Okay, will not waste time. Okay, first what you need to do, for dirty power, steps to solve this on calculator, type the base on calculator. What was our base? It was 900, 1000 divided by 900. We have to take it in decimals. Okay, we'll take it and then press under root 12 times. Under root will press 12 times. Okay, and then we'll multiply it by power. If it is 3 by 10, we'll do 0.3. Okay, in our case 1.3 it was that, we'll do it. Okay, now add 1 to it. Okay, we had to add 1 to it. Okay, will minus 1 into 0.333. Okay, we'll add 1 to it, then we'll do 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, I might have made some mistake and plus into, but you will get this answer. Okay, minus 1 and you will get the answer. Okay, if you do minus 1, we'll get the answer. Next, notes. If we discount the future cash flows from bond using YTM, then we will get current market price of bond. Okay, this is what we were doing. We were taking out intrinsic value. Okay, this is what we were doing. Current market price means price at which bond is currently selling or trading in the market, or quoted price of the bond. Okay, simple. If question asks to calculate prevailing interest or yield on similar bond, then it means we have to calculate YTM. Okay, prevailing interest or yield on similar bond means in similar bond what are we getting, what is the prevailing interest rate in the market. Okay, which means what, we have to find discounting factor. What is discounting factor? YTM. Next, spread of yield. This one is important. I'll show you the questions in next lecture. Okay, spread of yield means YTM of our bond minus yield of similar bond. Okay, our bonds YTM minus yield on similar bond means what, how much is the difference between the R bond and similar bond. Okay, spread. What is the spread? Spread means what, difference. Okay, YTM of our bond minus yield on similar bond. Realized yield means what, it means YTM calculated on the assumption that all coupons and payments and redemption amount will be received together at the end of the maturity period. So it becomes as zero coupon bond only. Okay, instead in zero coupon bond there is no interest. Okay, there is no coupon. Here all coupon payments are made at the end of the year. Okay, that is the only difference. How will you do it? Like zero, it is similar to zero coupon bond, so its formula also becomes like zero coupon bond. Total payments received on maturity, that is a face value, right? Total payments received on maturity, that is a face value, right? Divided by current market price of bond, the whole bracket 1 by n minus 1. Okay, this formula I have taught you how to derive it. So derive it and get it. So total payments received on the maturity of the bond is equal to all coupon payments plus redemption amount. Okay, so that's it for today. I'll meet you in the next lecture with questions.